Hello, everyone, and welcome to Fundamental Auditing, Chapter 15. Chapter 15 is wrapping up the audit. It's on completing the audit work and what the final steps you have to do before you provide the opinion. So there's some accounts that can't be audited until year end. So the audit of several year-end balances are covered in all the accounting cycles that we've talked about throughout Chapter 11 to 14. But there are some procedures that are particular to the year end, such as subsequent events, contingencies, presentations, and disclosures. And then final wrap up of the audit we'd have to go through as well. Okay, so for the revenue and expense accounts, we want to make sure that revenue accounts represent all valid transactions. They're recorded in the proper period, amount, and proper account. If there's any accounting for consignment sales or goods that have rights of returns, we want to make sure that that's recorded properly based on the accounting principles. Expense accounts should have all valid transactions recorded in the proper account, amount, and period. We have to make sure that revenues, expenses, cost of goods sold, and any extraordinary, unusual, or infrequent transactions are classified properly. So if something should be in OCI or should it be in other comprehensive income or should it be in revenue? So we want to make sure that's classified properly and that it's disclosed. A number of the revenue items that you have to test at year end are audited as part of like the other cycles like I was showing. And working paper files should show cross-referencing to these revenue and expense sections, right? If they've been audited elsewhere, like in the accounts receivable section, for example. So they're looking at all the revenue and expense accounts. Most of these would have been audited in other areas. What areas that they've been, what areas they relate to, and like depending on the different cycles that they're in. So like having sales returns and allowances would have been in the receivables, would be in the receivables accounts. Lease revenues would be in your fixed asset and receivable accounts. For example, like dividends and interests would be in your dividend receivable and investment accounts. So all of this, when you're looking at your end, looking to audit the revenue and expenses, most of them probably would have been audited doing other things like auditing the fixed assets or auditing the receivables. So you could just cross-reference back to that section and not have to do any more work if you've already gained enough sufficient audit evidence. Okay. Looking at like cost of goods sold would have already been audited in the inventories. Looking at R&D expenses would have been audited in the finance and investment cycle. Okay? So we've talked about how to go through and audit most of these revenue and expense accounts already. There's some minor expense accounts like office supplies or utilities that you wouldn't be covering in other areas. So those ones you would do at year end of the audit. Usually these types of accounts are small, so auditors usually just apply analytical procedures to these accounts. And if there wasn't a big jump from prior year to current year or anything like that, then it probably would be okay just to look at that and maybe a few invoices and stuff. Sometimes there are miscellaneous accounts that are set up in the expense account section. Miscellaneous accounts or clearing accounts. These need to be analyzed to make sure that they're not just dumping things that they've done incorrectly into these miscellaneous accounts, or maybe the company's trying to hide something in these miscellaneous accounts. So those need to be looked at in detail. And then any accounts with income tax implications need to be analyzed carefully as well. So any accounts that's going to affect the current income tax or deferred income tax would need to be looked at carefully. You would probably do over another analytical, some more analytical procedures at the end of the audit. So do ratio analysis, comparison to prior years, comparison to budgets, especially if you got the audit client to do some adjustments for some errors that you found. So throughout the audit, if you found a bunch of errors and you ask the client to make the adjustments of these errors because they are material and they did adjust for it, then you want to do an overall analytical procedure after all those adjustments are done, um, just to see if there's anything that's missed here. Okay, like I said, all miscellaneous or other, like, other income accounts or other expense accounts need to be analyzed properly to say, like, why is there an, other expense account? What does it include? Maybe you want to see some invoices. Um, so you want to make sure they're properly classified. So should they be going in other income or other expense, or is there an expense there that it should be going to instead? So miscellaneous accounts could contain accounting errors or incorrect classifications. So you want to try to clear those out if they should be belonging elsewhere. There also could be some unusual transactions. Management could have created all these complex transactions in order to manufacture some earnings that shouldn't actually be there. So there could be transactions that are running through a series of different subsidiaries or related parties, or like bundled sales or something like that. So you want to make sure that you're looking at audit evidence in any unusual transactions. And if the transaction sounds complicated or complex from what management is telling you and you don't really understand, then maybe you would want to look at a work of an expert or something, or find another audit team member who knows more about transactions going through a series of subsidiaries or something like that. So what basically happens during the year, we do some interim audit work. So during the year, before year end, we can evaluate the internal controls. So we can get an understanding of internal controls at any point of the year. We don't have to wait till the end of the year for that. We can also begin working on the test of controls. If we decide to test controls, we can test them during the year, because if we're just testing the process, that process can be tested at any point. So that we can do before year end. We might be able to do some substantive procedures at an interim date, because that might lessen the amount of substantive procedures you're doing at year end. At year end, you're going to complete the work on the test of controls. If there was any test of controls you're doing for year end purposes, like testing cutoff, for example, making sure the amounts are in the correct period, you're going to complete the substantive procedures as well after year end. And it may take months after the actual year end date to complete this work. So if the client's year end is December 31st, it might take up until March or April for the auditor to issue an audited opinion, because it might take months for the auditor to do all the work necessary to gain the appropriate audit evidence that they need. One thing that an auditor has to do after they're done their work, so the last thing that they would do is they're going to obtain, or one of the last things that they do is they're going to obtain a lawyer letter and a letter of representation. And this is dated the last day of the field work. So the field work is basically the amount of time that the auditor spends getting that audit evidence. So they first plan the audit, then they go in and actually do the audit. So while doing the audit is called field work. So the last day, when they're done gaining all their evidence, is when they would obtain a lawyer letter. The auditor is responsible for determining that all important events that have occurred till the last day of field work are reflected in the financial statements. So that's why we have to wait for the last day of the field work to obtain the lawyer letter from the lawyer. So the last day of field work is going to be months after year end. Auditors are required to make request from the client that they can talk to the attorney, so whoever the lawyer is for the client, to provide the auditor with information of any like contingencies that might be missing on the books, any litigations, any claims or assessments. And then we could probably do some other audit procedures to determine any other contingent liabilities that could be around. Okay. So yeah, we'd have to obtain a lawyer letter as part of our work in order to see if there's any contingencies that should be recorded on the financial statements that are not. So that helps us make sure that the liabilities are complete. So it goes through with the completeness assertion. We also have to do subsequent event testing as well. So events subsequent to the balance sheet date. So for example, let me just make kind of a quick timeline. Okay, so December 31st, let's say December 31st, 2020 is the year end of the company. And at this, so maybe you do some audit work before year end. So maybe you're doing some audit work here, and then you're doing the majority of your audit work after year end, especially your substantive procedures. And maybe your last day of field work. So this is your last day. So maybe it took you a couple months to do the work. Your last day of field work is March 15th. So March 15th, 2021. So your subsequent event period is basically from year end to when like the financial statements are finalized. So maybe that's the date that the financial statements have been finalized, because you've given any misstatements already for them to fix. Okay. Right, so there could be some things that happen during this subsequent event period that could create an adjustment on the financial statements, on the year-end financial statements, or maybe they don't require an adjustment, but they have to be disclosed. Okay, so type 1 events are events that would require an adjustment. Type 2 events are events that wouldn't require adjustment, but would require a disclosure. So you did learn about this in intermediate accounting too. So basically, if there's any adjustment that's required, it would be because a subsequent event provides new information regarding a financial condition that was existing at year end. Okay? So for example, if one of the things you have is an AR balance from a customer of $100,000, but a few weeks after so you have an AR balance of 100,000. A few weeks after year end, you find out that the customer went bankrupt, and that audit client is never getting their 100,000. So they're not actually going to get 100,000. They're going to get nothing because the customer went bankrupt. Right now, the books say that there's an AR of 100,000 coming in, when you know that there's going to be no money coming in. So that's a type of subsequent event that would require an adjustment. So the client would have to go back and, instead of recording 100,000, record 0. So that's something that we'd as auditors have to watch out for if there's any subsequent events that do require an adjustment to the financial statements. And another example is a settlement of litigation for amount different than estimated. So you might be adding a contingent liability. So maybe you have the client. So maybe the client has set up a lawsuit liability at the end of the year for 20,000. Let's say that this is material. A few weeks after year end, so this would have been an estimate. So the lawyers would figure out, what the amount is that's likely to be paid. So they're thinking, okay, they only have to pay 20,000. Maybe a month or two after year end, the client or the lawyer finds out maybe the lawsuit, the court case is settled, and now we know the actual amount of payment, and maybe the actual amount of payment is 80,000. So what the client would have to go do is adjust their year-end balance to 80,000 instead of 20, because now they know how much they will have to pay, because that 20,000 was an estimate. Now they've gained new information to provide a more accurate estimate of that amount. Okay, so those are the types of adjustments that we need to look out for, or those about types of events that we need to look out for as auditors to determine if has the client made the adjustments for this, or if they haven't, then we would have to get them to make it if they are material. Type 2 types of events means no adjustment, but disclosures are necessary. Um, so no adjustments because it doesn't change the numbers at year end, um, but it may require disclosure. Um, so you can provide the users with the information that they need so things aren't misleading. So for example, if December 31st, so let's say your inventory amount, so let's say December 31st, the balance in the client's inventory was, $2 million. Then shortly after year end, there was a fire, and a fire destroyed, let's say, $600,000 worth of inventory. You wouldn't have to write the inventory down at year end to 1.4 million because at year end, the situation was that they had $2 million of inventory. The fire didn't occur until after year end. So this is something that you would have to disclose and say, although something that the audit client would have to disclose and say, although the year end inventory amount was reported at 2 million because that's what it was, shortly after year end, there was a fire that destroyed $600,000 worth of inventory. Okay. Or maybe there was issuance of shares shortly after year end, or an issuance of debt shortly after year end, that maybe the audit client didn't want its users to know that shortly after year end they got a loan because maybe they're waiting for after year end to have these financial statements out there to get this loan. So that's something that we would, as auditors, have to make sure that the audit client has disclosed on their books, because we don't want to mislead financial statement users to thinking that their debt is so low on their balance sheet when a few days after year end it's not. So Exhibit 15-5 has some procedures for after year end. So I can quickly kind of show you some of these. Okay, so there's some procedures that we have to do, such as using the bank statement to examine any checks paid after year end that maybe should have been listed on the bank reconciliation. So look at the deposits that were in transit at year end. Have they now been posted in the bank statements? So we can just check like the bank statements for a couple of months after year end to see if all those have been posted. We can do some subsequent receipt testing, which means that we can, if there was at the end of the year, if there was accounts receivable balances, a couple months into the new year, we can determine if those accounts receivable balances were paid. If they were paid, that means that they were true. They should have been recorded at December 31st as they were. If they're not paid a couple months after year end, then maybe we have to look at whether they should be, there should be an allowance that's more, or should they have been written off or something. We would do the same thing for accounts payable. So if there's a bunch of accounts payable set up at year end, we would look at the cash disbursements after year end to see if those have been paid. We can also look at any cash disbursements in the couple months after year end to determine if there's anything that they paid for after year end that they didn't record as a liability at year end, which would have related to that year. Okay, so subsequent receipt testing is looking at their cash deposits and cash disbursements that went out after year end, but before the end of the field work, of the auditor's field work, to see if there's anything missing that they should have recorded, or did the accounts receivable that were recorded make sense to record. Any write-downs of fixed assets that occurred right after year end could give us evidence that there might have been some like impairment issues at year end, and those maybe should have been done at year end instead of after. Other things that we would do is for subsequent events, we could look at the latest available interim financial statements. If they create monthly financial statements, maybe we can get the month of January and February and see if there's anything there that would it make sense, any unusual fluctuations compared to the year end. We could inquire with officers, executives that are responsible for financial and accounting, whether the interim statements for the new year have been prepared the same basis as the previous year. Scan the accounting records for any subsequent events. So look at like the general ledger, journal entries, sales journal, purchases journal for the new year, and see if there's any unusual transactions or entries there. So those are the types of procedures that we can do after year end for subsequent events. All right, sometimes auditors need to dual date the audit report. So in the audit report, the date of the audit report should be the end of the fieldwork. But if there is an additional later date where you find a subsequent event that either needs to be like that needs to be disclosed, for example, then you would also put in this later date, showing that, okay, we did our fieldwork ended on this date, but then we found something after that date. So if fieldwork ended March 15th, for example, but then you're wrapping everything up and it takes a couple weeks for you to wrap up the audit, the working papers, and make your conclusions and issue the audit report. Maybe in those few weeks that you're wrapping everything up, there was some sort of subsequent event that would need disclosure on the financial statements. Then you have to put that date as well. So that's the date that you stopped auditing. You would have stopped your field work, but the date that you actually stopped auditing, in case you found any other issues. If there's no other issues after the date of the field work that you found, then you would only put one date, which is the date of the field work. Management also has to provide written representations. So the auditor needs to also ask management if there's any contingencies, litigations, claims, assessments. So they have to ask the lawyer that in a lawyer letter, but they also ask management. Management has to provide a written representation to the auditor. So on the client's letterhead addressed to the auditor, signed by whoever the responsible offices are, and dated as of the audit report date. This representation basically has something in writing saying what management is responsible for and what they've attested to. So they've attested that the financial statements are fairly represented. They've attested to the fact that there's no unrecorded contingencies. So it generally provides weak evidence because it's just management saying we did this, we didn't commit fraud when creating the financial statements. So you do have to find other evidence, but sometimes management representations are the only evidence available if there's no backup. So let me show you what a written representation letter looks like. So in 15-7, so it's to the auditor, and basically it's saying that we've confirmed the following. So this is management, or those that are responsible for the financial statements. They've said that we've fulfilled our responsibilities in preparing the financial statements. We've presented them fairly according with IFRS, for example. The assumptions that were used in accounting estimates are reasonable. So that's what they're attesting to. They're saying any related parties have been appropriately accounted for and disclosed. Any subsequent events have been that require adjustment or disclosure have been adjusted or disclosed. Okay, so it's just saying that this is all the stuff that we've done. We've also disclosed to you any information in relation to any allegations of fraud. So they're saying that they did that too. They've disclosed any non-compliance with laws and regulations that they know of. So it's basically saying that they've done all this stuff, and it's signed by the person responsible. So in this case, the CEO of the of the auditee. So that's what a management representation looks like. We'd have to get it put it in our audit file, but this doesn't really provide us evidence that just because management is providing in writing that there's no fraud, doesn't mean that there isn't. So we do have to get that additional evidence that we would go through during the audit. All right, so I showed you 15.7 already. Okay. Auditors also have a responsibility to obtain reasonable assurance that related parties have all been identified, and the transactions are properly recorded and they've been disclosed in the books. Okay, so related parties, which you would have learned about in intermediate accounting too, exist when one party has the ability to exercise control or significant influence over the other. So when the management of one company is the same management of the second company, so those two companies would be related, or a father owns company A and a son owns company B, so those two companies would be related. Okay, so if any control or significant influence over the other. So in IFRS, um, the related parties have to be disclosed. In ASPE, there might be an adjustment that you would have to do to the transactions. So when recording the transactions with the related parties, um, they may have to be done using the carrying amount. So you need to make, as an auditor, we need to make sure that any material transactions between those two related parties are recorded properly and make sure that everything is disclosed properly. Okay, so we can make inquiries in management, ask what all your related parties are. We can look at like an kind of like an organization of the company and who they've invested in. Do they have significant influence over those companies that they've invested in? We can review the board of the minutes. Watch out for any unusual transactions that don't really make sense. We would have to make sure that we look into those in more detail. And then after the audit staff has done the audit documentation, the working paper files, and put in all their evidence and cross-reference everything and have a big audit document of everything done and completed, there needs to be it needs to be reviewed by an audit supervisor in detailed. This is done to make sure that that everything is documented properly. So what type of procedures were done, how the evidence was obtained, what the results of those procedures were, what type of samples were chosen. So all of that has to be documented in the file. And a supervisor would have to review that in detail. And then the audit manager and audit partner will focus a review on the like overall scope of the audit. So they can look they can see an overview by looking at the analytical procedures and kind of see if there's anything, if sufficient amount of evidence was obtained. And then a second partner review is conducted as like a quality assurance. Yeah, so the audit partner on the audit will take a look and review the file, and then a second kind of independent partner will also review the file. And then that's the end of completing the audit work. Okay, so thank you for listening and take care.